Howdy, y'all. Welcome back. It's the weekly economic update for Monday, February 7th, 2022. Hope everyone had a terrific weekend. I got to shovel a little more snow, which is always fantastic. Woke up Saturday morning and looked out the window and snow all over my driveway. So I was like, yay! Or maybe it was yesterday. That was yesterday, Sunday. But it wasn't too deep, so don't feel too bad for me. Like I said, hope everyone had a great weekend. If it's your first time watching, hit the subscribe button. Also, share with friends and family. I would greatly appreciate it. So let's go ahead and dive in and see how the markets did today. The Dow Jones was flat. It was up a total of 1.39 points, closed at 35,091. The S&P 500 was down 0.33%, closing at 4485. NASDAQ down 0.58, closing at 14,015. Small caps are up about 0.5%. The VIX was down about 1.5%, which is good at 2286. So the closer we get down to that 20 number, the better. All right, let's take a look across Europe. Mostly greens. It looks like one was the AEX was up over 1%. Couple of reds. Looks like the IBEX and the FTSE MIB were down slightly. But mostly greens as we head into Eastern Europe and into Asia. Those markets were mostly positive. The Nikkei and the S&P ASX 200 were down, but most of the Chinese markets were up 1% or 2%. So again, looks pretty good. So to recap, looks like the Asian and Eastern Europe markets were in the green. Same with Western Europe. And then here in the U.S., most of the day we were up. NASDAQ was the one that was the laggard most of the day. And then in the last hour or so of trading, the Dow and the S&P 500 flattened out or went into slightly negative territory. So, all righty, let's go ahead and dive into this week's weekly update. The week on Wall Street, stocks managed to gain ground last week as investors turned their focus to corporate earnings. The Dow rose 1.05%, while the S&P 500 gained 1.55%. NASDAQ was up 2.38%, and internationals were up 2.73%. So it looks like international was the big winner last week. Earnings in focus. At the start of the week, stocks extended their previous week's rally with some high growth companies leading the move higher. Strong company profits fueled the market in the middle of the week until the earnings disappointment from a mega cap company took investors by surprise. I think they're talking about Facebook. The earnings miss deflated sentiment as it heightened worries of what may portend for other technology companies yet to report. These anxieties led to a sell-off that reverberated across the market. Subsequent earnings beats from several technology and social media names and an above consensus rise in new payrolls on Friday helped the market close the week with a solid gain. So, Omicron and unemployment. A string of unemployment reports pointed to a generally healthy labor market despite the Omicron surge late last year. The JOLT survey showed a hiring slowdown with near record high job openings and worker resignations. The ADP employment report saw private payroll shrink by 301,000. That was the first monthly decline since December of 2020. More encouragingly, initial jobless claims declined while continuing jobless claims reached their lowest level since 1973. A strong January unemployment report showed 467,000 jobs added during the month, with upper revisions to previously released November and December. All right, so this week ahead, economic data coming out. On Thursday, we have the Consumer Price Index and jobless claims. Friday, we have consumer sentiment. And we have a bunch of companies reporting earnings. Today is Amgen. Tomorrow on Tuesday, we have Pfizer, Chipotle, and Cisco. Wednesday, CVS, Walt Disney, Twilio, Yum Brands, and O'Reilly Automotive. Thursday, we have Twitter, Coke, Illumina, Duke Energy, PepsiCo, Kellogg's, and Expedia. And then on Friday, Dominion Energy. All right, well, let's go ahead and take a peek at the monthly update for this month, or actually a review of last month. Let's go ahead and look at the U.S. markets. Rising yields, elevated inflation, and a hawkish sounding Fed took turns rattling the stock market in January, with technology-heavy NASDAQ particularly hit hard. The Dow Jones Industrial Average dropped 3.32% in the month, while the S&P 500 index fell 5.26%, and the NASDAQ lost 8.98%. So for those who are heavily weighted in the tech stocks or growth stocks, that's probably why you've been getting beat up on your statements. Fear of the Fed. Anxiety about the Federal Reserve's pivot from its accommodative monetary policy towards monetary normalization hung over the market all month. Early in the month, the Fed released the minutes from its December meeting, which suggested a more hawkish tone than what investors were expecting. Well, let me stop there. Who was not expecting interest rates to go up? I mean, seriously, anyone who's got their head squarely out of their ass knows that interest rates have to go up because they've been at zero for, I don't know, more than a decade. Come on. I mean, no one was caught off guard. Inside the Fed minutes, the first update that unsettled markets was the likelihood of an interest rate increase in March, which would be sooner than many had expected. The second update that upset investors was the news that the Fed was considering reducing its balance sheet, a step towards tightening that had not been widely anticipated. Really? That's shocking. I mean, $8 trillion on the Fed's balance sheet is a lot of money that we've shelled out to cover those investments. So anyways, more from the Fed. Following its January meeting, Fed Chair Powell indicated that reducing the balance sheet might come at a faster pace than the balance sheet reductions of 2014 and 2018. Bond yields trended higher in response to Powell's news. Higher yields hurt technology and other high valuation companies the most. Economic recovery. Amid the stock market turbulence, the underlying fundamentals showed a solid economic recovery. Unemployment fell, housing was strong, and the fourth quarter gross domestic product rose beyond consensus expectations, but hot inflation tempered enthusiasm. Earnings underway. A strong start to the fourth quarter earnings season caught investors' attention. Of the 33% of companies comprising the S&P 500 index that reported by month's end, 77% reported earnings well above Wall Street estimates, while the total beat percentage was higher than average. The amount of which earnings actually beat analyst estimates was by a narrower margin. Stocks rallied sharply in the final two sessions, taking the edge off an otherwise challenging month for investors. All right. So, it seems like those in the press are trying to make excuses for why the economy has so much inflation and such. We know exactly what caused it. Printing trillions of dollars and buying up toxic assets is the primary reason. So anyone who wants to argue that with me, you're welcome to call me and I'll have that debate with you. All right. For one white paper going out this week, states are requiring retirement plans with new mandates solve an old financial problem. Too many Americans save too little for retirement. Gee, shocking. The problem has been discussed for decades in all kinds of media, and there seems to be no easy way to solve it. 14 states are giving it a try, however. They have passed and introduced laws requiring or urging companies to provide retirement saving opportunities to employees. In most of these 14 states, employers must either sponsor a retirement plan or automatically enroll their workers in a state program. Payroll giant ADP notes that a majority of states have considered mandatory retirement saving programs. A similar mandate is being discussed on Capitol Hill. HR 2954, informally called the Secure Act 2.0, would require employers to auto-enroll employees in workplace retirement plans. This bill stalled in Congress in 2021, but the House and Senate are likely to revisit it this year. California and New York are among the states now stipulating worker enrollment by June 30th, 2022. Any private employer in California with more than 5 full-time employees must offer those FTEs, full-time equivalents, or employees a retirement savings program, enroll them in the new Cal Savers retirement plan, or face fines after 90 days of noncompliance. New York now requires most businesses and nonprofits with 10 or more employees to either provide retirement savings choices for them or auto-enroll them in the New York State Secure Choice Savings Program. Well, let me stop there. I don't know if anyone would trust their money in any government established plan. Look at Social Security. It's fallen apart because, the people who run it have pilfered all the money out of it. So, just from a private employer perspective, the government has no right to tell, any business whether or not they should offer a retirement plan or not offer a retirement plan, a pension, healthcare benefits. I mean, that's up to the business. If you don't want to work there, don't. I mean, you can walk into your local bank and open up an IRA in about 10 minutes. You can go online to TD Ameritrade or Robinhood or any of the online brokers and set it up within minutes. So forcing in a business, I mean, because what it does is it adds a lot of extra compliance that and just work that most I mean, if you build engines, understanding how to set up a 401k plan, or having to add that cost into your budget to offer that, it just seems like it's outside of the purview of the state, and people are responsible for their own savings. All right. Where did I leave off? In Vermont and Washington, the mandatory mandate is voluntary. In all 14 states, employees have the right to opt out of the state-run retirement programs. Will efforts like this solve the problem of inadequate retirement savings? Not entirely. Only about 50% of Americans participate in employer-sponsored retirement programs. Tens of millions of Americans lack access to any kind of retirement plan. Even if Secure Act 2.0 becomes law, its automatic enrollment stipulation would not be retroactive. Automatic enrollment would only be required for new workplace retirement plans, not those created in the past. It would also allow employer-sponsored retirement plans to set a deferral rate as low as 3%, and many financial professionals would like to see savers direct greater percentages of their earnings towards retirement. The list of states with retirement program mandates, either live or oncoming, include California, Colorado, Connecticut, Illinois, Maine, Maryland, Massachusetts, New Jersey, New Mexico, New York, Oregon, Vermont, Virginia, and Washington. 21 other states have introduced bills into their legislatures that could create similar requirements. So again, I'm all for people saving. I'm all, if I had my druthers, I would, everyone in America would save, 20-25% of what they make. They'd have a nice little nest egg set up, and they wouldn't have to depend on the state to bail them out when they make bad decisions. But, most people have high time preference. They prefer to spend their money now as opposed to, having a low time preference and deferring it till later. But, that's just the way, that's human nature. All right. Got a few articles I want to breeze through. Bank of America strategists warn Fed hikes in pricey market to end poorly. Alrighty. This comes from Bloomberg. Optimists expecting the stock market to weather the rate hike cycle as they've done in the past are missing one important detail, according to Bank of America's strategists. While U.S. equities saw positive returns during previous periods of rate increases, the key risk this time is the Federal Reserve will be tightening into an overvalued market. The strategist led by Savita Subramanian wrote in a note, the S&P 500 is more expensive ahead of the first rate hike than any other cycle besides the 99-2000, they said. U.S. and European stocks have made a rocky start to 2022 amid concerns that more aggressive monetary steps to tame inflation will hamper the recovery. While a positive earnings season is easing some worries over less forgiving macroeconomic backdrop, equity markets have remained volatile and strategists are divided about what lies ahead for the rest of the year. B of A's team is squarely in the bears camp, expecting the U.S. benchmark to end the year at 4,600 points, implying just 2% above current levels. The strategists argue that the closest historical precedent to the present outlook is the monetary tightening at the turn of the century, which ended poorly for stocks with the bursting of the tech bubble. The pivot from super dovish to more hawkish policy underscores that we are at the point of peak liquidity, they said in a note on Monday. While other notable Wall Street voices, including Morgan Stanley's Michael Wilson, share their pessimism, the assessment is by no means a consensus view. JP Morgan Chase & Co.'s team reiterated on Monday that growth will remain solid this year and with still more upside for equities following the ferocious rally of 2021. For B of A strategists, though, an abundance of red flags, including valuation, sentiment, fundamentals, and technical factors, point to a poor year for equities. Moreover, we believe that the risks to equities would be greater if the Fed did nothing. They wrote, runaway inflation would likely compress the S&P 500 multiples and cut into earnings. So that's, basically a lot of the same information that I've been saying is that we are headed for a rough stretch in equities. Probably in bonds too, with the raising of interest rates. I mean, and look at it from this point of view. Would you want to buy a 30-year bond at, I don't know, what's the rate now? About 2.5%, 3%. And then interest rates go up to, I don't know, say 7 for long-term fixed income. So, would you want to buy a 3% bond today that you get 3% for the next 30 years? Or would you want to rather wait and when interest rates go up by, say 2 years from now, buy a 30-year bond at 7 or 8%? Those 3% bonds are going to lose a ton of value. So I mean, it's kind of damned if you do, damned if you don't right now. It's like the stock market's overvalued. The bond market, is priced in dollars. And, with the inflation that they're seeing and, we know pretty much for certain that rates are going to go up. The current bond inventory out there is not going to be very appealing to those wanting to scoop those up. All right, next article: dollar up, euro down as pair face off in a rate hike tussle. It's written by Herbert Lash. All righty. The dollar and the euro both eased on Monday after European Central Bank President Christine Lagarde claimed market expectations of a quick hike in interest rates that pushed regional bond yields in Europe to multi-year highs. There is no need for big monetary policy tightening in the Eurozone as inflation is set to decline and could stabilize around the ECB's target of 2%, Lagarde told the European Parliament hearing. Last week, the ECB opened the door to a rate hike later in 2022 as inflation risks rose, while data showing an unexpected jump in the U.S. jobs created in January also raised speculation of a faster timetable for the Federal Reserve to hike rates. The new rate expectation for both the Fed and the ECB pit the dollar and the euro against each other, as to which will gain an upper hand. U.S. consumer price data to be released on Thursday is poised to be a key data point determinant. The euro dollar will be in a kind of tug of war between these two forces, but ultimately with the CPI in the US, we're probably due for a bit more of a dollar recovery, said Kathy Lean, a managing director at BK Asset Management. A Reuters poll of economists showed that they expected year-over-year CPI to have climbed to 7.3% in January. The major currencies traded in a tight range near break-even. The dollar index fell 0.045%, with the euro down 0.03%. The ECB last week got the ball moving in the positive direction for the euro, said Joe Manimbo, senior market analyst at Western Union. Now the focus has shifted to U.S. inflation, which the market will use to figure out whether the Fed goes by 25 basis points or 50 basis points next month, Manimbo added. Markets have now priced in 1 in 3 chances that the Fed might hike by a full 50 basis points in March, and a reasonable chance rates will reach 1.5% by year end. Let's hope. All right, so that's about that there. So we're going to probably see some swings and a little bit of a fight between the dollar and the euro. I don't think either currency is in real great shape, but we will see. All right, next article here. I'm gonna go ahead and skip. I'm gonna skip this one. Let's see here. Here we go. All right. Time to rethink the Fed. This is written by John Malden. Came in my Saturday newsletter. And what he's talking about here is, the Fed at this point is in a world of hurt. And instead of just some minor tweaks, it might be time to actually scrap, or not scrap it in his opinion, but a major overhaul. All right. In many important ways, the financial crash of 2008 had never ended. It was a long crash that crippled the economy for years. The problem that caused it went almost entirely unsolved. And this financial crash was compounded by a long crash in the strength of the America's democratic institutions. When America relied on the Federal Reserve to address its economic problems, it relied on a deeply flawed tool. All the Fed's money only widened the distance between America's winners and losers and laid the foundation for more instability. Fragile financial system was wrecked by the pandemic, and in response, the Fed created yet more new money, amplifying the earlier distortions. This was a quote of Christopher Leonard. One of the hardest leadership challenges is knowing when to change plans. Is what you could do better than what you are doing. Certainty is impossible. At some point, though, good leaders recognize their plans aren't going well and start looking for better ones. I believe the Federal Reserve is there. I don't mean the Fed's current policy dilemma. I mean the Fed itself, its very existence, structure, and goals. They need a complete restructuring because the Fed isn't accomplishing what we all need it to. Worse, it's causing problems we could do without. I believe Fed officials are largely responsible for the cycle of bubbles, booms, busts over the last 30 years. Further, they share some of the blame, clearly not all, for the growing divisions and tribalism in our society. Much of it springs from the wealth disparity they aided and abetted. So that's pretty good quote there. I've talked before about how the Fed has painted itself into a corner. All the options are bad and getting worse. Reason it is in this position are no mystery. Indeed, this is all inherent to the Federal Reserve's systems design. It is trying to do things it shouldn't be attempting. The only real solution is a wholesale redesign and reconstruction. What we have today isn't working, and the time has come to amend the Federal Reserve Act and change its purposes and authorities. I realize those are bold words. I fully acknowledge the gravity of what I'm proposing here, and I'm totally open to ideas for what a new and better Fed would look like. I know any transition from here will be tricky too. It will also take time. I do not expect anything to happen of any substance until we get to the Great Reset, where we would be forced to think and do many things now unthinkable in the current environment. In the meantime, I fully expect the current Federal Reserve will increasingly inject itself into the economy and make things worse. Its leaders will do so with the best of intentions because they believe in their own dogma. In their view, it's just what they do. We need to have this conversation, and it has to start somewhere, so I'll start it. So today, I'll start it. We should first ask why the Federal Reserve or any other central bank is even necessary. Answering that leads to much deeper questions like, what is money? And who should create or control its value? Many libertarians and Austrian school economists argue governments should have no role in it at all, something I totally agree in as a libertarian. I probably would have been sympathetic to that in the late 19th century and early 20th century. I will now no longer argue for the Fed's full dissolution. We need central banks with limited capabilities, just like young children need training wheels. My goal is to improve the present system and reduce its harmful side effects. Modern central banking is fairly new. Until the 19th century, private banks commonly used their own currency, notes sometimes linked to gold, but not always. Wars and political machinations created instability with periodic panics and bank runs. Banking was not a system as we know it today. Banks did their own thing, and if yours had trouble, it was your problem too. Let's stop here and make an important distinction. Today, we associate central banks with fiat money without independent backing like gold. That was not always the case. You can have both a gold standard and a central bank at the same time. A central bank standing behind its individual banks helps maintain stability, thereby promoting the confidence that attracts deposits. This would be important even in a 100% reserve system. So, all right. So that's a pretty long article. I'm not going to go ahead and read through everything, but it is good to see that those who are in the big wigs in the economics game are starting to talk about this. So this is a positive sign. I personally think that currency shouldn't be under the control of any government. We should be able to trade currency. We should be able to decide what we want to use, whether or not it's gold, Bitcoin, dollars, whatever you want it to be. But a currency not backed up by anything and it's just printed out of thin air, it hurts everyone else when that happens. All right. One other little piece of information here. The U.S. is to stop facial recognition for new online account authentication. I don't know if any of y'all had seen this going through the headlines. They were doing facial recognition to, submit your tax returns. So I guess there was a lot of backlash, and they've gone ahead and decided that that's not going to be a thing. So they're going to look at finding another way to confirm identities rather than using facial recognition. So, all right. And then one last bit of information. Let's see here. Scientists find putting pantyhose on your head makes your mask safer. So I thought I'd share this. This comes from Vice, and it was written by Samantha Cole. So in this article, I'm not going to read through the entire text. Some of the suggestions were taping the edges of a mask to one's face, filling in the sides of a mask with gauze, binding the mask to the face with gauze, the mummy method, putting a knot in the ear loops, so it holds tighter against your face, rubber bands around the face to create a brace against the mouth, and a slice of pantyhose wrapped around your face. I guess to create a better seal. So you can see here in these photos, like here's the pantyhose black method. And I guess you wrap it around your N95 or your surgical mask and it holds it tight against your face. Here's the mummy method. I guess you wrap surgical gauze around the outer parts. So, for those who are really worried, I would also point out you probably want to wear goggles that seal around your eyes because you do have tear ducts that run into your sinuses from your eyes, and corona can get in through there. So you can put on the best mask possible, but if you're going to walk around with your eyes exposed, it's kind of all for naught. All right. Well, that's everything I had for today. Some interesting, little tidbits there. So use that responsibly. I personally would not wear that on my face, but y'all are welcome to do so. All right. Well, hope everyone has a fantastic Monday night, and I'll be back tomorrow with the Liberty Call. If anyone needs anything from me, don't hesitate to reach out via email or phone. It's a clear day, so if you want to send some smoke signals, I might see them. The sun will be up for another hour or two here before it goes behind the mountains. So again, hope everyone has a fantastic night, and I will be back tomorrow. Bye.